The IMF came out today with their twice-a-year report on the state of the global economy and the financial stability of the world. And in short, the view is that growth is projected to hold steady, but problems exist, and that the comment from the head of the IMF sums up her view pretty clearly, which says our forecasts point to an unforgiving combination of low growth and high debt, a difficult future. Now, when I went through this morning, somebody from Asia said, well, the IMF is always negative. And I said, that's correct, because they're dealing with loans to countries that are having trouble paying them back on a regular basis. So they tend to see things from a negative perspective. But the numbers are actually interesting. They do have some positives and negatives, but I think the challenges exist in the world today, as we know. And we'll touch on those challenges in one sec. But the good news is that inflation is come down quite a bit. And as you saw, from 9% overall down to about 3.5% as they're looking in the out years. But the battle's not won yet. And a lot of the policy prescriptions from candidates getting elected from around the world could be highly inflationary. So some challenges still exist there, but we can be thankful for the prices coming down. Unfortunately, or for inflation coming down, unfortunately, prices still remain elevated, and that's hurting the poorest people around the world. But we have had some good signs. Inflation in the labor markets are easing without a recession. This is a look at the US and the Eurozone, and you're looking at jobless rates and policy rates, and we've navigated pretty well so far, but there's more work to be done, and that's a big part of the report from the IMF. One of the big challenges is, as I touched on a minute ago, is that prices still remain elevated and they're impacting the poorest nations the most. And as you can see from this chart, clearly the advanced economies are continuing to see incomes continue to rise, although at a slower pace. But look at the challenges of the prices rising in the low income and emerging market economies. That's a real challenge as we move forward. The other challenge is that growth is going to be uneven. And even in the emerging markets and the developing markets where they've had high growth for a while, and even now the projections from the IMF on emerging and developed economies are for about 4.2% for this year, 4.2% growth for next year. And in many of these emerging and developing Asia, for example, they're growing at 5% or more pretty consistently, but that's not translating into necessarily significantly better economic outcomes. And I think that's because we're failing to address the debt, job, and investment need problems because we don't have enough money to go around to solve all the problems that we have. And governments are not focused on a few problems that they can address over time. They're trying to put quick needs and get votes, really, is what's going on right now. So I think the tyranny of the urgent's overtaking the right decisions, and that's leading to even more difficult growth outcomes. A big problem is debt around the system. We have $100 trillion of public debt. It's about 93% of global GDP, and it's on the rise, as you can see here. And what's happening is as we get this move out into the next couple of years, about 2/3 of the nations involved in this charting here will see better debt to GDP levels. Unfortunately, the third that doesn't represents about 60% of the global economy and about 50% of the population. So where the improvement is going to come in debt to GDP is not in the areas that are most economically important. And that's a big problem that solving this requires us getting our debt under control. And if we don't, it's going to create a bigger division between those who succeed and those who don't. And here you can see the cost of debt and the debt servicing crowding out other spending. And this is a look at low-income developing nations where the interest expense to government revenue tripled from around 5% to 15%. And then you're seeing now in the emerging economies, not counting China, it's basically doubled. And that's a crowding out of all these other spending needs. And governments are struggling right now to deal with this and maintain stability of the population and stay in power. So what they're doing is continuing to offer more giveaways and making this problem even worse because we're going into more debt. So you need to find examples of countries that are working out of this differently. And is Argentina one of the ones? David Lane could weigh in on that a little bit later. But there's policy prescriptions. I think one of the areas that's getting most impacted by this is a lot of the LATAM countries where the rise of the left becoming even more left in their policies is creating bigger debt problems and bigger debt servicing problems. And I don't know how you get out of it, given that you've had high growth, but you don't make productive use of that growth in a lot of the nations. Further complicating the problems is national security and global conflict is diverting dollars away from those social needs. And you can see here from this chart, the rise in military spending from 2000 to 2023 or 2022 versus if government development assistance, where they're providing some of the social spending that's required to help lift people out of their challenges. That continues to be an issue. Further complicating the problems are the changing terms of global trade, particularly around tariffs and protectionist policies, a lot of which started with the Trump administration in 2016, accelerated with the war in Ukraine and the pandemic in 2020, 2021, and now moving into another election cycle and further divisiveness and conflicts. You're seeing it really ramp up. And as we have these trade restrictions go on the system, you tend to get slower growth and higher prices, at least in the intermediate term. And that's also weighing on the system. So you have a problem where we have 40% of the world's population, or 50% is going to the polls this year. And what's the discourse been from politicians? It's all about how do you get the votes? So they tend to be pro-expansion, not pro-restraint. And it's interesting, you see the backlash in France and other countries that are trying to say, we have to get our spending under control. What happens to those guys? So they say the truth will set you free, but I would say it won't get you reelected or elected. And we're dealing with a problem where the debt bill is coming due. And I think we have to get better policies that balance out lowering costs, lowering spending, without raising taxes much, but you probably will need to raise taxes in a lot of the world. I think the targeting of taxes and making taxes what they've been in the US, which is a rich versus poor thing, doesn't move the needle the right way. So I think we need different discourse and a balance between the pro-expansion and the pro-restraint that's more aligned with where we were in earlier times, not trending the way it's trending right now. And then you have the demographic cliff that's overhanging most nations, except in these developed low-income areas. And what this chart is really saying is where the capital is and where the growth is not where the population growth is. And in those developed nations and leading nations below here, as you can see below, that most of them are below replacement level population growth. How do we get out of this as we move forward? And you know, GDP is a reflection of two things, population growth and productivity growth. So we're putting an awful lot on productivity because one of the challenges is capital is not being attributed to these areas. It's hovering in a few of the leading nations. And that means we have a mismatch and misallocation of capital versus needs. Again, we have to work through. So when you have such high debt and demographic problems, you need to improve productivity. I spelled it wrong up top. Productivity is the key to getting out of these problems. And while it's not the solution to everything, it has been said by Paul Krugman that it's not the solution to everything in the near term, but in the longer term, it absolutely is. And I think given the demographic cliffs that we have, the need to raise productivity is absolute. I think that's one of the big drivers for where we are today. So how do you get back on track? I think there's 4 big risks, according to the IMF, and 3 big remedies. I think the risks are geopolitical. I would say there's 2 risks, and Ray Dalio's done some really good work on this, but we have a really unusual situation where the US is one of the kind of leading economies, and considered the post-World War II global leader by many, is having incredible domestic divisiveness. At the same time, we have an emerging competitor in China that is pushing the boundaries for leadership with the US. And when you have the two conflicts going on at once, domestic conflict and global conflict going on, it creates a very tenuous situation. So the geopolitical risk is high. I think the protectionism that's going on and changing terms of trades is another big risk. And a lot of the world's waiting to see if Trump wins and what his tariffs might do. I'm not sure he can get all of them across, but he can get a lot of them in place. And I think that could be pretty dramatic on the system and not necessarily a good thing. I think renewed labor market weakness could be another element that triggers some recessionary pressures. And then obviously new financial market turbulence. When you have so much change going on in the system, the reactions and actions to monetary and fiscal policies and trade policies can be quite disruptive and create financial turmoil, disrupt supply chains, and create bigger issues. So any of those are the risks. The remedies are pretty clear, though. Monetary policy has to be brought back to a level that you gradually take the world off of life support that monetary policy has provided since 2008. So you have to do that gradually. We can't attack debt and just force too much fiscal constraint on the system, or you'll create a system. But you also have to get debt down and start rebuilding the buffers because the next crisis will come. Second thing is you have to have fiscal policy be a little bit more aware and enlightened and aligned to the challenges. We just can't keep giving away money and not making productive use of it, because in a lot of nations, those giveaways go in the hands of a few, not helping the broader system. And we've talked about this in the 8 o'clock call. Corruption in some of these low-income countries is stealing the future of the population and limiting the growth. When they're growing at 5% consistently, why aren't they getting better economic outcomes? It's because of unproductive spend through either corruption or a misallocation of capital. And then lastly, you have to boost productivity. And to do this, we're going to have to solve some of these problems together, which means the world's leading nations, world's leading economies have to work together differently than they are right now. And I think we have to get past the conflicts that we have. We've lost the peace dividend that we've had for most of the World War II period. We're in a different time. So I think we need to be really careful. I'm really fascinated by the fact that in the US, the markets have hit new highs in the S&P. Since the Fed cut rates 50 basis points, the long end of the market has risen almost 60 basis points. So we're seeing the market rise because of earnings and expectations of a lot of cuts that might not be coming, and expectations that China was going to stimulate their way to a level that will move the whole global economy. And I think one of the things that we're realizing is the China stimulus is for stability, not for global growth. And that has a different dynamic than what we're used to. So I think as we move into the election and move into the next period of time, you're going to see some unusual choppiness before we resume a more of an upward trend. And I think the dynamics will continue to suck capital into the US. Keep an eye on the yield differentials around the world. And a lot of the world was hoping that the US was going to be on track with the rate cuts that the market projected following the September cuts, where we're going to see a series that would take us down to a couple 50 basis point cuts and continuing down to like 2% on the 3% on the Fed funds rate. I think the market's expectations have been slowed down by that. And if the US doesn't move as much, it's harder for other nations to move because it creates distortions in the currency markets that we have to be careful about. And that's where some of these financial crises start. So I think the Fed's easing at a slower rate will make it more difficult for some of these other countries to lower rates. And that means we have to really rethink what the expectations were following the September rate cuts as we go into the election, which is now 2 weeks away. So Mark, I'm going to stop there, open it up for discussion.
Thank you, Stephen. Let's open up for discussion. Questions, comments? Adam Blanco.
Stephen, good morning. Very sobering presentation. You mentioned that China's stimulus is for stability, and that will have a different dynamics for global growth. Can you dig into that a little bit
Yeah.
more?
When
What do you
China
mean?
was going through that great industrialization period, early 2000s, really 2010, when they stimulated after '08, it was a massive stimulus on industrial. So it really affected the whole global system, commodities, the whole works, right? Energy prices moved up. With all the conflict that we have in the world right now, you would expect energy prices to be moving up a lot, right? But they haven't. They've actually come down. One of the reasons is China's stimulating really for stability, not for global growth. So their demands aren't as great. That's one sign. Even in the copper area, where when China expands, you usually see copper move up a lot. Copper prices have been relatively stable. So their impact on commodity markets, their impact on the energy markets is not the same, because they're really trying to offset a debt problem and not create further debt issues. Even though they are layering on more debt, they're trying not to create a runaway debt problem. So it's a different purpose. And I think President Xi is playing the long game here. And this is where the Chinese can do things that other nations necessarily can't, particularly the US, where you take a much longer term view. They can deal with some of the pain in the short term. In the US, we go 2-year election cycles basically now. So policy prescriptions are constantly changing here. I think they're going to try and deal with their debt problem in a more systematic way.
Thank you, Stephen.
You're welcome.
And Giovanni?
Oh, okay. If I remember correctly, you don't really believe in modern monetary theory, but something that you mentioned about the marginal productivity of the debt spending, you said that presently debt spending isn't that productive. Within the context of modern monetary theory, could you tell us what spending you find to be below average, marginally productive, and what spending you find to be above average, marginally productive? So no taxes on tips and overtime, is that good or bad? Above or below marginal productivity?
Yeah, I think the giveaways that are being talked about are insane. I think you have to go and determine what areas of your economy can you be competitive globally in, and are you supporting them in a way that they can compete and be effective? And are you creating, or do you have the spends going to areas that are going to create better national security, better productivity for your system, better economic outcomes, not things that get you reelected necessarily for getting reelected's sake. So I do think most of the policies being put out are missing the mark. And I think you need truth and honesty from your politicians. And the truth is, you're going to have slight higher taxes, but you really need to rein in expenses in a much more efficient way. And you have to take the government spending that's going on and make it more productive. And in a lot of economies, that means reducing the corruption that exists in the system today. Because if you look at the emerging economies growing at 5% consistently, why aren't they translating that into better outcomes?
So America's Inflation Reduction Act, as it relates to energy policy, renewable or fossil fuels, incentives for drillers to go for fossil fuels, do you find that to be a above average productivity or below average? Is that wasteful spending and a giveaway, or is that good spending that does in fact stimulate the economy?
I think it was both. To be clear, because I do think that elements of the Inflation Reduction Act were giveaways that were gimmicks versus some that were really designed to improve outcomes and drive better national security and better energy security. And I think that was an important element of it. I think some of the giveaways are just that and become non-productive spend. If I was if it was up to me on the student loans, for example, I would not have waived the principal. I would have waived the interest, particularly on government stuff, so that we at least hold an element of the contract to be, if you borrow money, you pay them back. If you change the interest because there was malfeasance by providers, I think you can deal with that. But I think there were things they could have done that would have been smarter policies around that. I do think the idea of the Inflation Reduction Act in and of itself, reshoring and bringing some manufacturing back for national security purposes makes a lot of sense. But I think that we should have partnered differently with our allies as we were doing that, so we were less disruptive to their economies as well. So I think there's a mix of how you do this that we didn't get right.
Thank you.
Michael.
So, Stephen, you lost me when you said that politicians have to tell the truth. All we have to do is look at what is being promised by either of the candidates today, think a little bit about it, and go, WTF. But that wasn't what I wanted to comment or question. So the 18th, Goldman Sachs came out with an analysis about significantly lower returns from stocks over the next 10 years. How do you see that playing out in terms of what you just talked about with the IMF?
We've gone through those periods before. A good look back would have been the early 2000s. I think that was coming after the tech wreck and the bubble that blew up then, and we did see low growth, and there were opportunities to make money there, like there are in any environment. But I do think that sooner or later we have to get back to economic cycles, and I think they're kind of pointing to there's only so many games the governments can play to keep stimulating growth without having normal economic cycles. And so I think that, again, this is part of the bill coming due. Companies that are over levered are going to be struggling because rates may not come down as much as they thought they were. And I think that's part of the problem that we're seeing in not only the public markets, but in the private markets, that that clearing mechanism is part of what's going to slow the growth, because we're not having the clearance, and the debt keeps accumulating. And if rates don't come down a lot, which you can make the case they won't, that means that you're going to have a slower growth environment with higher inflation and more difficulty in getting corporate earnings. So I think their case is a good one. I don't particularly, it doesn't bother me what their projections are as much as do I think we can find opportunities. And I think whether it's in the private or public area, there's so much going on that in innovation and disruption that's going to create a lot of winners and losers. I think the biggest thing we're going to see is how do you capture the haves and have-nots, and are you with the haves or you're with the have-nots in your portfolio? And Michael, you sucked me into last week to do something that I try and avoid every time, but you got me to give a political answer that I didn't want to give. So congratulations.
Remind us again what that is.
And we're trying to move on, Roger. Any more comments or questions?
Hey, Mark, could I just follow
Hi,
up?
Bill.
Yeah, morning. Could I just follow up just real briefly on
By
that?
the way, Bill, you looked really good in our Chicago conference with those sunglasses.
Oh.
It's a good look for you, by the way.
Thank you. It doesn't work so well inside. Otherwise, I'd do it for the fashion.
You should do these outside then.
Yeah. So in the let's see, let me try to just share this real quick. Going to the point of kind of low expected returns, I shared.
Look, this I love this. Bill Deuchler just taking control.
Sorry, I never saw a slide that I didn't like. So is the survey 17 this?
Yep.
Okay. So if y'all remember, kind of expected returns going into the 2000 crash were steadily coming down because we were realizing returns, quite handsomely going into the 2000 crash.
Yes.
And so then, kind of post 2000 crash, you can see it's the blue line, dark blue line is the S&P 500. Again, like not getting back even between the 2000 crash and then getting hit again with the GFC. Not getting back even until more or less April of 2011. So you can see the effect of high realized returns out, pre 2000, decreasing expected returns. And so I think we're getting into that same type of situation here, where we've had very high realized returns, and yet the expected returns are, decreasing down. I'm just going to see if I've got my expected return chart in this deck, which I don't. But I think if you all remember kind of the expected return chart, public equities are in the 8 to 9% range, at best for the next 10 years, based on the data sources that I'm seeing. Nonetheless, I mean, clearly the economy and the world economy, was plugging along. But I think the adjustment in terms of one possible outcome for public markets and perhaps the knock-on for private markets too, when you get excessive realized returns, is something to think about. Now, it could keep going, but it's certainly something to think about. And again, we have had these kinds of outcomes in the past.
Thank you, Bill. Other questions, comments?
I'll throw another one out here. So Stephen, I don't know, this may be unfair, but I think your chart in terms of the contributions to percentage of GDP growth was really, really interesting. It would be fascinating to look at it on a dollar rather than a percentage basis, on a dollar value basis.
Yeah. I don't have, I can get that, but I'd have to take a look at it. But it is interesting. So if we're going to, Bill, if you think of it this way, if we're going to grow at 3%, 3.25%, on a $100 trillion economy, it's slightly over, say, $110 trillion economy. China was supposed to be 22% of that. I think India's 13 and the US is 11, to give you some perspective. So you can do the math.
Right. Yeah. So even though the U.S. economy may not be growing as fast as China on a dollar volume basis, we're still contributing a heck of a lot.
Yeah. Yes. Europe, I just don't have the number for. It wasn't a knock on Europe, although the European growth numbers are pretty sickly for this year and next. They're, looking at the leaders would be maybe Spain or Portugal in Europe in terms of growth, from what I'm seeing so far. But Germany's looking at 0.8% growth next year. France is looking at 1.1%, Spain at Italy at 0.8%, and the euro area overall at 1.2%. That's tough growth rates given the problems and the debt levels.
So I did want to just point, I see that David and Adam, you both have your hands up. And by the way, we have a mobilization call at 10:30 tomorrow. Adam and David and Andy Fish and David Mollings and some others will be on because we're mobilizing our LATAM deep dive. So carry on, guys. Maybe David, you first.
Well, I mean, Latin America is different position than the rest of the emerging markets. I mean, like Southeast Asia. I mean, the growth is not quite there. I mean, it's barely hitting 2%, right? And we have high taxes. The cost of money is more expensive there than here, and it's tough for those people to afford growth, right? To grow, to invest in business and actually make a profit. There's so many structural issues, right? This inflation and the high inequality, and like Stephen had mentioned, I mean, between low productivity and corruption, it's a tough uh, place to go. That being said, there's a lot of opportunities because people are getting tired, and that's the reason they're going left, right? Because the right wasn't able to do anything for them, and they don't vote because the left has better policies. They vote to punish, right? Like, you didn't take care of me, you're out. So there's a lot of work to do there, but there's a lot of opportunity. They need so many things, and I think it's the right place to go, especially with these things going on with China. Geographically, Latin America is positioned to receive a lot of growth, you know, and not just logistics, but factories. You know, people moving over there from different countries to avoid this tariffs and whatnot. So I think there'll be a good opportunity to move in there in the next few years. I mean, starting now and for the next few years.
It is interesting, David. You're looking at, according to the IMF, Latin America and the Caribbean, 2.1% this year, 2.5 next year, and I would suspect the 2.5 is aggressive for growth. And but I think for your breakout, the difference of the policies that Mexico's put in place the last several years and what is going on in other countries down there, like what Milei's trying to do, is a really interesting dynamic to say which approach might be a better outcome for the economies. And so I think you have a very interesting topic of economic policies versus politics colliding as to how do you get out of a problem like you just described.
They also have the problem of currency depreciation. I mean, there's several countries that are dollarized, you know, whether formally or informally, but that's a big issue, especially now with U.S. Lowering interest. You know, it's complicated. Could it be a good thing for them because it will lower their cost? But then at the same time, if it's slowing down productivity in the U.S., it could be troublesome for them. So,
well, I think we're not going to lower costs as much as everyone would like. So I think you're right. That puts additional strains, particularly on their dollar debts. I didn't mention the Middle East and Central Asia, Mark, where their growth rates are, you know, 3.9 for that region, and then, you know, Saudis are at 4.6%. That's pretty healthy growth. India at 6.5% next year, and China at 4.5. So there is growth going on, but it's not the strength of the growth that I think can drive the economy past a lot of the problems that we have.
Right. Adam, you had your hand up?
Yeah, just a quick comment. A few weeks ago, I wrote about the declining demographics in Russia and the impact that the war is having on that. And as I wrote that in doing the research, it's quite astonishing what the UN is predicting in terms of global demographics, saying that China, by the year 2100, will be less than 600 million people compared to what they are today.
Yeah. And in Russia, it's less than 70 million?
Yeah, that's right. Yeah, less than 70
It'll
million.
be halved.
Yeah. And China's half as well. So in Latin America...
Where's the U.S.? Where's the U.S. on that one?
U.S., I can't remember the U.S. I wasn't focusing on the U.S. at the time. But I think the U.S. has, despite the immigration policies, how messed up they are, you still have immigration into the U.S., unlike Russia. It's, you know, their primary sources of immigration before 2014, was Ukraine and Central Asia. Now, Ukraine's off the table, and Central Asia, they've taken Central Asia off the table as well because of growing nationalism.
Yeah.
So all of this is compounded by the demographics, and it's not pretty. That's assuming all things remain constant between now and 2100. they won't. Probably somewhere in the middle, I guess. I won't be here. So,
You never know.
but that's very challenging.
And you talked about 2021 or 2100, but in Japan right now, in China right now, in Korea right now, they are seeing negative population growth.
That's right. That's
So
right.
it's not down the road. It's happening right now. I think
Yeah, it's happening right now.
Japan's down,
Yeah.
I think, around 800,000 last year in population, 900,000 in population. So you lose a million people every year. That gets to tough way to grow your economy.
And on top of that, Stephen, you've got an aging population, and that's particularly true in Latin America as well.
Yep. And that creates strains on the government with the worker dependency ratios and who's paying for all the Social Security benefits when nobody wants to vote for extending how long you have to work before you retire.
And it becomes a question of who's going to pay for this, especially in an environment where you have such big wealth inequality.
You know, there's another element, Adam, that's making the population problem even worse is a lot of young people around the world are so disillusioned with the way the world's going that they don't want to bring kids into the world, which is actually slowing the population growth down as well, because they think the problems that we've created for them are so great that they don't want to bring kids into the world.
Yeah. I put the graph that I used from that graph in the chat is from the United Nations.